Hi, welcome to my YouTube channel. Welcome to Let's Finance Your Freedom. So I've been researching a lot about day trading versus like investing on a regular basis and keep it long term to see what is a better investment strategy. And during my research and my comparing all the data, found out that the day trading, 95% of the people who day trade can lose money. Very small percentage of the people who day trade can earn some money or break even. So the statistics are stacked against you when you want to day trade and you want to pick stock and then try to do it like a swing trade, which is like you try to buy it when it's low and sell when it's high. There's so many studies. I found at least 2 to 3 different studies out there. People based on statistics and tests and data. It's not just like what people think, but at least 3 articles out there. They comparing the results of people who day trade. You're probably gonna lose money about 5% to 20% only those people able to break even or have some make some money. And the average amount of money that people make from day trading is around, the most recent data in 2021 is only about 70 to 80 grand per year, and you're trading they're trading full time or consume a lot of the time to day trade. So it's not, for me, I look at all these data, it's not a good way to earn money or to invest your money into day trading. First of all, it's consume a lot of your time, attention, and mental energy and focus into day trading, even though some people claim that they only day trade for about less than 4 hours, between 2 to 4 hours a day, and versus working your 9 to 5 or 8 hours a day to make on average about 80K a year, which is not really a good way to invest your time and money and effort and stress. Even though you day trade only for 2 to 4 hours a day, but your mental energy and your mentality, your stress level is really high, even though you're not really actively trading or thinking about your trade or comparing or researching all the stocks, but you're still being stressed out after all those time. The market closed and you still stress about how the stocks or this trade or this your guess on things is correct or not, or how the stock market is plummeting, and your psychology or your mentality is going downhill. Tracking the stock market or trying to time the stock market is really difficult. So I'm trying to find a better strategy, and I want to share some of the great articles that I found with you on this YouTube channel, so that hopefully it would help you to start trading, not start trading, start investing to the stock market the smart way. You don't have to work hard, but you just have to work smarter. So one of the 2 articles that I found is really quite interesting. I really like this one article. I'm going to be talking about this article for a majority of this video is about the 5 different strategies that people 5 different strategies that are out there, and they're comparing these 5 strategies, again, the historic returns and data based on these strategies. So let's just say that you have hindsight and you have a chance to look back in the last almost 90 years, is backtrack all these data based on these 5 strategies back to 1926, from the data from currently to all the way back then. And what they found out, these 5 strategy, I'm going to be going over them. I'm going to be linking that article down in the description below if you're interested in reading through the study and description about what they found out. Feel free to do so. But the first strategy that the the article was talking about is perfect timing. So it's called, this person called Peter. Peter Perfect, meaning he able to time the market, during that whole year. Let's just say that he knows exactly when the market gonna tank, and he's gonna buy when it's really low, and then hold it off for that amount of time, for example, like 20 years. buying and let's just say S&P 500. So that's the first strategy. So you can only buy once and sell after that 1 year, or you can only sell it. You can only buy into the market one time. Okay, so that strategy is let's just say that you know exactly when it's gonna tank, and you're gonna buy it and hold it. Okay, and then the next strategy is called the next strategy. Let me take a look to see. So it's gonna be action. It's called actually action. It means that this person were given $2,000 in the beginning of the year, and all she does is just take that $2,000 and buy and invest into that S&P 500 at the beginning of the year and just hold it there for 20 years. And the next strategy is called Matthew Monthly, and this person is going to be representing the dollar cost average strategy, meaning that for every month they're gonna invest into the S&P 500 12 equal month 12 equal proportions, meaning 2,000 divided by 12, and every month he just invests into it every month, so 12 times a year. And it's called dollar cost averaging, not trying to time the market, not trying to wait until the market is dropping and then trying to buy into that market when it's dropping. So this person is only gonna invest every month no matter what at that exact time. So and that once a month they're gonna invest that exact amount of money into the S&P 500 and just hold it there. And the third strategy is this person is called Rosie Rotten, meaning that it's have poor timing into the market, and she would just invest into it at the wrong time. So she invested her $2,000 each year, and she's just gonna be. Let's just say there's a time in the middle of January or the end of January, and she invested into it, and it was just the bad timing, and the market was really high, and she gonna be invested again at another peak at the end of the year or something like that. So that's the fourth strategy. And the fifth strategy is this person is called Larry Linger, meaning that this person is not trusting into the stock market and just afraid of losing money altogether. And all this person does is gonna invest into something called cash investment on treasury bills, kind of like a safe way to park your money into the treasury bills or like money market, or something that you're not gonna lose money. You're just gonna save it in there. So convincing that stock is too risky, is too hard to figure it out, and that's the fifth strategy. And the result is really interesting to find out that of all these strategy, of course, the first strategy, Peter Perfect is able to time the market perfectly when the market tanks and he buys into it. And realize it or not, it's really there's no such thing as Peter Perfect, because that's like playing God. You can't really. Nobody can really time the market exactly when it's gonna tank and when it's gonna go up and down. We don't know when the cycle's gonna be ending or starting. So the result found out that the first person which is Peter, was able to gain after 20 years he about to get between the time of 2001 to 2020, so 20 years, okay, investing $2,000 every year into the S&P 500. So the first person able to gain, not gain, but total, they come out with $151,000 roughly, and $391. So 151, 391. And the next person is Ashley Action. She invested into the stock market, as soon as she has the money in the beginning of the year. So let's just say she has $2,000 right then and there, and January 1st or January 2nd, whenever the market opened beginning of the year, and she just invests her full $2,000 every year into the stock market, into the S&P 500 for 20 years. And at the end, she gained $135 and $135K, okay, $471. And the next person is called Matthew Munley, and this person gonna invest into the dollar cost averaging. Remember, every month he investing into the S&P 500, regardless of whether the market is going up or down, and he's able to earn $134,000 and $856. So very small percentage of the difference, like less than 1% difference between Ashley Action versus Matthew Monthly. And then comparing to bad timing. So this person who, Rosie Rotten, just time it, was not able to be lucky and just put the money into the wrong time, and she able to come up with $121,000, 171. And then not great, but comparing to 134, which is monthly, Matthew Monthly, it's about 134 minus 121. That's about $1,300 difference. And then stay in cash investment. So the last strategy, he comes up with $44,000, $438. So meaning that, just not involved into the stock market and not invest into the S&P 500 and just hold the money in cash, you're actually losing money a lot more, like almost 3 times or 4 times, comparing to somebody who dollar cost averaging, which is $134,000 comparing to $44,000 that the last person had. So it's like 3 times, losing money in 20 years for not taking action, not investing into the stock market. Now, the first strategy, of course, we know there's no way you can time the market. But what you can do, the better strategy is going to be either invest money into the S&P 500 as soon as you have money beginning of the year, as soon as you have that money. It doesn't matter if it's beginning of the year or not. As long as you have access into money, just invest into the S&P 500 and hold it there. And if you don't have money in the beginning, like most people do have money right away to invest, then the better strategy was still, not the better, but it's still, the more reasonable strategy would be to do the dollar cost averaging. And it's really quite interesting. The more I find out more about in dollar cost averaging, the more I realize it's really one of the the easiest way to invest, and not having to think about it, not having to stress out about when to time the market, when it's going to be going up and down, and worry and stressing out and pulling money out, like day trading. And in day trading, you can lose money, versus in these studies, even they compare to different 20 years time frame, different time frame from 1926 S&P 500, different 20 years from 1926, different 20 years time span. The same results showing up, with these 5 strategies, even though they compare at different times. So this numbers that I was reading to you was really comparing it at a time of 2001 compared to 2020. So that time frame, but the results are very, very similar. So if you learn anything from this video or this strategy or any of these numbers and strategy I was telling you, that it's better to do dollar cost averaging, and you don't have to second guess, you don't have to really stress out thinking what you're gonna do and pulling money out back and forth, losing money and paying more tax when you do day trading, active day trading, versus you hold the money there into either S&P 500 or a certain selected groups of stocks that you have done your research, and you're going to do better. So I hope that this video helps you to convince you to consider your strategy, and let me know what strategies that you use or that you discover that really works well for you, and what articles or what study, what research have really motivated you to invest more. And I hope to see you in the next video. I'm going to be sharing more about these findings with you in the next couple of videos. So stay tuned.